Hello everybody and welcome to that episode on my channel. So today we will be looking at one of the sectors in my portfolio, specifically the railroad sector. I often get asked by people why railroads make up such a large percentage of my investment portfolio at 13%. So I've decided to make a video to address those questions and hopefully provide some insight into my overall investment thesis of investing into railroads. So if that's something that you would like to watch, I encourage you to watch this entire video. Now, if you've been watching my videos and you've enjoyed the content, I please encourage you to subscribe. It helps to keep me motivated to continue making these videos and helping other investors along their journey. If through the series of videos that I've made, if they only help one investor, I will consider myself very happy, as the whole point of this channel is to pass down the investing knowledge that I have to other investors and help them on their investing journey. Again, I'm not selling anything here. This is a no fluff channel, just passing down the knowledge that I have to other investors. So without further ado, let's go and look at this railroads sector here. So what I've done is I've made a brief presentation here detailing railroad stocks and why I invest in railroad stocks, and are railroad stocks a good investment? So that is essentially the question we will be asking. So let's go and look at this. What do we want from an investment? So two main characteristics here. Reliability. So we want our investments to be reliable. We are investing for the long run. So we want the companies that we invest into to be consistent and growing in the following aspects. We want growth of cash flows. The whole point of investing into a company is to get cash flows from that investment. So every investment that you make is the present value of those future cash flows coming from that company to yourself as a shareholder. So when the cash flows are growing, they're consistent, that is a very, very valuable aspect in a company that we want to invest into. Revenue growth. So again here, we want revenue to grow at a reasonable rate over time. When revenue grows and the company is efficient, that will lead to increased profitability. Now, with increased profitability, revenue growth, and cash flows, the company can then provide to you, the shareholder, a return in the form of growing dividends or capital appreciation of that equity holding over time. So we want all of these characteristics here to be in an investment that we are putting our money into. Remember, shareholder return, total shareholder return, is what we are aiming for here. A lot of people, they focus on the dividends only or capital appreciation of growth companies, but what really matters is the total shareholder return, which is the dividends and the capital appreciation. Now, the second characteristic here is longevity. So we want our investments to have a long lifespan. We want them to be able to continue to create and grow all of these aspects here over a long time period, thereby rewarding us as shareholders. So when we are looking at investment and longevity specifically, we need to have companies that have a moat. So right here we have, an example. Think about a castle and how a moat guards the castle from intruders. So when you're thinking of a moat, and maybe a lot of you have not heard this term before, or you have, and that's fine, but in medieval days, when you had a castle and you had a moat, which was the body of water around the castle, intruders could not get to your castle because of that moat. They needed to get a drawbridge or whatever to cross the moat in order to get access to your castle. So businesses are very much like that. Think of the business as a castle and the moat as the business practices or the products, services that they provide in order to protect that business and continue to generate its cash flows, revenue growth, profitability, and shareholder return. So that is how you should think of a moat. So a moat is basically maintenance of a competitive edge over the competition. So when a company can have a moat, they have a competitive edge over other competitors, and it makes it very, very hard for other competitors to either replicate or outbeat that company or outperform. So for the railroads here, as we can see, that construction of new railroads, it's very highly unlikely. So we'll look at that a little bit later, but that is one of the key characteristics of their moat. A lot of railroad tracks have already been laid. It's super hard to lay any more, if not near impossible. It's very highly capital intensive, so you need a lot of money to start a railroad. So it's pretty, well guarded, and the moat around these companies is very high, and we'll look at that in a minute. Again, the moat was popularized by Warren Buffett and Charlie Munger, great investors, some of the best, if not the best. So you can check that out on your own time. That essentially is what a moat is a competitive advantage over the competition. It guards your business and allows your business to perform and compound over time. So we're going to look at the railroads here. So I've decided to detail list the Class 1 North American railroads. So these are the biggest railroads here in North America. We have Union Pacific, ticker UNP. Canadian Pacific, they just merged with Kansas City, but their ticker is still CP. NSC, Norfolk Southern Railway. Then we have CSX Corp, which is CXX. Burlington Santa Fe, BNSF. This is held under Berkshire. So that is held under Berkshire privately. And then you have these which you can publicly buy on the stock market. So let's go and look at the actual tracks of these railways. So as you can see, they spread all across North America. So this distance is huge here for these railways. So let's go and look at them in detail. So here we can see CP Railway here in orange. So they go from here, into Canada, into the States, and then they also merged with Kansas City, which is the purple line. It's a little hard to see here, but that actually goes down to Mexico now. So CP and Kansas City, that is the orange and purple. Then we have UNP, all of this yellow right here. So you can see it spans all over the United States on the western side and the central side. So again, a lot of railway track there. We have CN, as you can see, very dominant here in Canada, runs all through Canada, across central, the east, the west, south as well, and it goes into the States as well. Then we have BNSF, so this is the Berkshire Railway. So again, this is Warren Buffett's railway. You don't have access to buy the tickers on the stock market, but you would buy Berkshire as they fully own this railway here. And again, that's in orange. Then we have CSX here. So CSX here more on the eastern seaboard of the United States, and then same with NS, which is NSC, again here on the eastern side. So as you can see, these railways span a large distance across both Canada and the United States. So feel free to pause and take a screenshot of that so you can have that for your records. But again, this is just to illustrate how far these railroads can go and the distance that they cover over both Canada, United States, and North America. So you might be asking yourself, okay, railways cover a lot of distance, but could you not do the same thing with trucking? A lot of people use trucking for transport and things like that, and that is 100% true. But there's different purposes for using different types of transportation. So trucking versus railroads. So trucking, it's usually when it's quick, you need something, a shipment that needs to be completed in a short amount of time. A truck can do that for you. They travel distances in short amount of time. There's one driver, it's reliable. They're with the shipment at all times. And they can get it from point A to point B, from city to city very quickly because they're actually driving on the road as opposed to railways, which move a lot slower. But the downside here being that it is costly, so you're paying that one driver, but you're also paying for the fuel costs, like all that gas, because they're using a large amount of gas in proportion to that shipment that they're making or that one load. Now, when you use railroads here is when you have large shipping volumes. So when you're transporting a bunch of coal or a bunch of merchandise and it needs to go over a long distance, railroads are most likely the best, I want to say the best source for you to use or the best option for you to use because you're shipping large volumes and they can carry these large volumes. You're just adding another cart to the railway track just onto that one locomotive and it can carry it over long distances. Again, it's not as quick as if you use trucking, but you can ship much larger volumes. So if you're very good at making your schedules, then you can actually plan to have these large volumes shipped at one time, and that can fit in with your timing schedule for your business. Now, railroads, as I said, they can ship a lot more, so which means that their fuel costs in proportion to the amount of cargo or the amount of items that are transported is comparatively cheaper to that of trucking. So again, trucking versus railroads. Trucking is when you need something done quick. It needs to be, reliably delivered within a short amount of time. And railroads is when you actually have a lot more time and you're shipping a lot more volume. It makes a lot more sense to use railroads. Now we're going to look at these stocks that I currently own. So I own UNP, I own CP, I own NSC, and I own CSX. So let's go and look at my investment portfolio, my tracking spreadsheet here. Look at my holdings, and I'll make this a little bit bigger. Okay, so here you can see CP Rail. So I'm up about 17% on CP Rail. And then we have Union Pacific. I'm about 6.5% on Union Pacific. And we have NSC. I'm about 12% on NSC. And we have CSX Corp here. I'm about 9% there. And again, these make different percentages or make up different percentages of my portfolio, with I believe CP being the largest at about 5.6% of my portfolio. Union Pacific at about 3%. Then we have NSC here at about almost 3%. And CSX was a newer position, and I was only able to add 1.24%. So that is the railroad holdings. And as you can see, I'm up pretty significantly on those. And let's go and look at the actual underlying businesses. So here's NSC. Let's go and look at NSC as an example. So here's my portfolio. It's here on Qualtrum. I just like to use Qualtrum because of the graphical representations here. It's a lot easier to pass knowledge in a visual manner. So let's go and look at my holdings. Now if we scroll down and we go to NSC. And let's look at the data annually. Okay, so NSC, it trades on the US stock market, on the NYSE, trades under the ticker NSC. Has a market cap of $53 billion, trades at a reasonable price to earnings of 18, forward price to earnings of 17.8, so basically 18 here. So those are just some valuation metrics that you can look at. The dividend yield, 2.30%, so very respectable. Payout ratio is a nice low 39%, so they have ample room to grow that dividend over time. Cash flow yield, so they yield a nice 4.5% of free cash flow. Again, investing into these railroads is a cash flow game. So we are looking at maximizing our cash flows over time, and we will look at that when we look at the graphs. The margins, so the operating margin here, a nice 35%, and the profit margin at a stable 23%. So that's great to see. Now the balance, we have a snippet of the balance sheet here, so just the cash and the debt. Very little cash at 550 million and a large amount of debt at 14.5 billion. So net debt at 14 billion. So we will look at why these railroads have a lot of debt. Again, all of them carry a lot of debt. It's just the sector and the industry as a whole here in the railroad sector. So let's go and look at the revenue. So the revenue, as you can see, it is pretty erratic, but it's moving to the right and up over time, just not at a very high rate. So if you remember, when we go back to our presentation, we can go back to the characteristics of why we want to own these railroads or what we want from an investment. So we want consistent and growing revenue growth. So as you can see here, the revenue growth is consistent. It is growing, just not at that high of a rate when you're looking at the 10-year revenue growth at 1.45%. But the past couple of years have actually been a lot higher. The past 2 year at 14%, 5 year at 3.85%. So it is growing, just not at a very high rate. And we will see why that is in a minute. Now let's go and look at their EBITDA, or earnings before interest, tax, and depreciation. So again, kind of the same or similar story here as revenue. It is growing over time, a little bit higher than revenue at 3.74%. So that means that they're controlling their costs a little bit better and their expenses, and they're able to generate a higher EBITDA return than their revenue growth. So that's good to see. But again, nothing too large here, just about 3.74%. But you'll notice that it is stable growth over time, and that's something that we want from our investment. Now, if we go and look at the free cash flow, the free cash flow tells a whole different picture. It's growing very, very nicely at about 10.68% per year over the past 10 years. Now, in the past year, they are down a bit at 18%, but when you look at the long-term trend, they are up a lot higher. They're generating large amounts of free cash flow, which they can then return to us as shareholders in the form of dividends or buying back shares. Now let's go and look at the free cash flow per share. Now here is where the railroad shines. So they are growing their free cash flow per share, or per the equity investment of shares outstanding, at about 14.20% per year over the past 10 years. So that is great. So as we saw, their free cash flow per share is actually growing faster than their free cash flow. So that tells me one thing. They are going to be buying back shares at a very high rate. Yes, so they have been using that free cash flow from their business and reducing the share count of their company. So by doing so, by buying back shares and canceling them, they are making you, an equity holder or a shareholder, a larger owner of the business over time. So over the past 10 years, they've been taking about 3% per year out of the share count and buying back those shares. So that is a return to you as the shareholder, because you become a larger owner of the business. So that's great to see. Now we can look at their dividends. So they've been growing their dividends at a very high rate over time, 10% per year over the past 10 years. So that's very, very great to see. As an equity holder or shareholder in this company, they are prioritizing the return of the capital to us shareholders at a very high rate. So that is awesome. Now what we can look at is their cash and debt. So we mentioned this above, but let's look at it again. So railroads, just the industry, they keep very little amounts of cash on hand. As you can see, this kind of hovered around that, 800 billion to 1 billion to 500 million. So again, it's very low amounts of cash. And the debt, they've been increasing that debt over time. So as you can see here, the debt was about 14 billion right here. So this is something you need to be cognizant of. Just think about this when you're investing in this industry. It is a very high debt industry because it requires a lot of investment of capital. Railways are expensive. They need to be maintained. Rail cars need to be bought and maintained. And they're using this debt also as a second purpose, which is leverage. So they're using this debt to buy back these shares that we looked at. So sometimes a lot of companies, they will end up doing that because they feel that they can get a better return for their shareholders by taking on debt and buying back these shares. And that's fine. It can be a very great way to reward shareholders as long as your debt is not maturing in the short term at high interest rates. So if they have this debt as long-term debt and they've financed it very well, they can actually produce a larger return as opposed to the interest costs associated with that debt. So that's something that you can look at on your own time. I have looked at it, and a lot of their debt isn't maturing for a long time, so I feel very comfortable holding them. So again, they're leveraging this up so they can buy back the shares. But when you look at their debt, $14 billion of debt, I usually have a rule where I try to invest in companies that have the ability to pay back that debt over 3 years or 3 times their EBITDA. So 14 billion, and their 2022 EBITDA was about 6 billion, so 6, 12, 18. So they could pay down that 14 billion of debt within 3 years. I'm totally fine investing into NSC because they have that ability. They're just opting to reward shareholders by buying back shares. And then my thought process is eventually they will reduce the share count enough that they just pay off the debt. So again, that is just speaking to the debt, and that's something to be aware of. So that was a look at NSC, one of my railway holdings. But again, I encourage you to look at the other railway holdings and do your research there, because that is also important to look at. Now, let's go and look at the total shareholder return. So I just went to averageannualreturn.com and I looked at the shareholder return of the various holdings that I have in my portfolio. So when you look at these railways, it's given us results without dividends reinvested and with dividends reinvested. We're just going to look at the ones with dividends reinvested because that is the total shareholder return, and that is the more relevant metric here. So when we look at the S&P 500, I did this over a 20-year period, so we'll use this as the benchmark. The S&P 500 here is in blue, and UNP here is here in the black. So UNP as a black line, if you invested, again, this is saying if you invested $10,000 with your dividends reinvested over a 20-year period, what would your return have been? So as you can see, UNP has outperformed the S&P 500 by a large margin. So it's, sorry, it's not even questionable here. So The total return here is about 2,000% for UNP compared to the S&P 500 at 543%. So the average annual return of UNP over this 20-year period would have been about 16.48% per year over the past 20 years compared to the S&P 500 at about 9.75%. So that is a huge margin of outperformance there by UNP, the largest railway in the United States. So let's go and look at NSC. Now NSC again here with the dividends reinvested, NSC here in black, and S&P 500 here in blue. Again, a large margin of outperformance. NSC over this 20-year period has returned about 15.68% per year over the past 20 years compared to that same S&P 500 9.75% per year over the past 20 years. So this is really great to see. We can see that the NSC and UNP, these railroads have outperformed the S&P 500 by a large margin. Let's go and look at CSX. So this is the smaller railroad of the group. So CSX here, it's amazing, the outperformance here has been even better because of this, relative smaller railroad. It's a lot easier for smaller companies to grow as opposed to bigger companies. But again, that's a discussion for a different video. So let's go and look at this level of outperformance. CSX here in black, S&P 500 here again in blue. The annual average return here of CSX Corp has been about 17.90% per year over the past 20 years, compared to the S&P 500 at about 9.75% per year over the past 20 years. So remember, again, these are railroads. This is 17.90% per year over the past 20 years. This isn't a tech company. A lot of people think that, you need to be a flashy tech company in order to gain large amounts of growth or, invest in these growth industries. These boring railroads have had amazing returns over the past 20 years. 17.90%, 15.68%. We have UNP at 16.648% per year. So these are amazing returns for these boring, stable businesses. That's just something that I want you to keep aware of or keep in the back of your head. Being the flashiest isn't always the best thing when you are investing. A lot of the times being boring, predictable, and cash flowing is the better option. So that was the average annual returns. Let's go back and look at the slides and just look at my closing thoughts. So longevity here, these are great moat businesses. The threat of entrance to this industry is very low. So you need to have significant capital to build a railroad. You need to have a lot of money like we saw. You need to be able to get past the regulators. So there's a lot of regulation in this industry in terms of safety, in terms of performance, a lot of zoning permits. There's so much regulatory information and background and filings that need to be done here that it is almost impossible to enter this industry as a new entrant. So very, very low chance, almost slim to none in my opinion, that we will get any new railroads. The majority of the railroads in the future, they will probably just come from consolidation of these current railroads that we have now. So those businesses, in my opinion, will only have the option to consolidate to grow bigger or continue operating by themselves. We have reliable, consistent, and growing EBITDA. Again, not the highest growing EBITDA, but it's reliable and consistent. The cash flows are growing at a very nice rate over time, and the shareholder return, like we saw, is just amazing. Anywhere from 15 to 17 or 18% per year over those companies that we looked at. So again, reliable, consistent, and growing EBITDA, cash flows, and shareholder return over long periods of time. So one of the things that we need to be cognizant of or aware of is the high levels of debt. Again, like we talked about, it's a very capital intensive industry. They need to invest a lot of money to maintain those railroads, maintain the track, maintain the cars, maintain the additional trailers and things like that. So there's a lot of money that needs to be reinvested into this business. So they have a high level of debt. And remember, they're using a lot of that debt too to repurchase those shares at a high rate, which increases our earnings per share. So again, those rates of return, they are sort of artificially inflated because they're buying back a lot of shares. And again, even though their earnings are increasing over time, they're buying back a lot of shares to increase their earnings per share. So they're taking numbers out of the denominator here to increase their EPS growth over time. And again, as long as they can do so while being aware of the fact that they are leveraging that debt to reward shareholders, and then they do have a plan to pay that off over time, I feel comfortable with that. Again, like I said, for me, my rule is 3 times EBITDA. If they can have that level of debt and it's under that 3 times EBITDA line, I feel comfortable investing in those companies, but you may not. So that's a decision that you need to make on your own time, and again, all falls in with your level of comfortability when investing into high debt companies. But they have proven that they've been able to do that over time, so I feel comfortable. So again, those are my closing thoughts. I hope you enjoyed this presentation, and if you do, subscribe to the channel and I will continue producing this content for my viewers. I hope you have a great day. Thank you. Bye. Please note, I am not a financial advisor by any means. This content is only for your entertainment purposes. And if you do decide to invest into companies, please note I am not liable for any investing decisions you make. Investing is inherently risky, and please do your own due diligence when investing. Thank you again, and I hope you have a great day.